Hello everyone, and thanks for joining me for this video. My name is Daniel Tenner, aka Swombat, and I mostly post market analysis live streams, but also posted a number of threads analyzing the NFT market. And this video is based on one of my threads published back in November, but still highly relevant today. And some people prefer to get their content via video. Hopefully this will help them. So today we're going to talk about basically Ponzinomics and how to recognize when a project is effectively trying to pay you off with investor money from the future, which is essentially what Ponzi schemes are about. Now, this can be very difficult to spot, and even for me, it takes me some kind of effort, and I have to think about it for a little while before I figure out, is this project actually delivering some real value? I find it's actually quite a tricky thing to figure out. So I'm not surprised that a lot of people struggle with it, especially since many projects are making great efforts to hide this, to obscure it, to obfuscate it, to make it really difficult to tell whether the project is basically a Ponzi scheme or not. And I'll add that even in many cases, some projects are not doing that deliberately. They're genuinely trying to build something of value, but they kind of stumble into Ponzinomics without really wanting to. This is not that surprising when you think about where Ponzi schemes come from. If you don't know, Charles Ponzi had a scheme that involved arbitrage of postage stamps or something like that he actually intended to run to create great returns for his investors. He just got so overwhelmed by the investor attention that he found that it was easier to pay off the earlier investors with the later investors' money. And it's plausible that maybe he didn't actually intend to defraud anyone. He just kind of fell into it and got overwhelmed by the fact that people were so keen to get these amazing returns that he was promising. More and more people threw their money at him. He paid off the old people with the new people's money. It worked out for a while until eventually it collapsed. If that sounds familiar, that's because that's the story that's repeated across many projects across the space, even many which are not actually outright trying to scam anyone, which is why it's important as investors that we learn to recognize when those projects are doing this, because often it's not intentional by the founders that they're doing this. So without further ado, let's start going into this. So the fundamental principle that I want to start with is that essentially most NFT projects, the ones that aren't pure art blocks, for example, you're just buying the art, or an art collection on Foundation or Super Rare, you're just buying the art. But most projects these days, the profile picture projects, they tend to sell you something called utility. They have roadmaps, they have plans for what they want to do, they have marketing efforts to attract investors, they have visions of what they want to achieve in the world. That's the starting point for me, that these projects are basically startups. That's what they are. They're organizations with a goal, with a plan, with money flowing through their veins, and they're trying to achieve some kind of objectives. And so comparing them to startups is actually very valid in my view. Now, the truth about being a startup is, or any kind of business, is you can't just create money out of nowhere. Crypto might seem to have done that differently, but ultimately, as long as you're interacting with the traditional financial system in some way, and all of us eventually want to get that money that we're generating out of crypto and into the traditional financial system, at least for now, while the metaverse is not the reality that we live in, as long as you're operating in that world and interacting with the traditional financial system, you have to at some point respect the equation that you can't just create money. Ultimately, there's going to be some kind of environment that you create where money is put in and then money is taken out, and the money in has to equal the money out. This is easiest to explain with some diagrams, so let's have some diagrams now. So here's a way to visualize a typical company. You might see there that, so like there's the project or the company right here in the middle. Investors usually put in money into an early business because they expect to see some kind of return as the business grows. So they put in money here, that's M1. That money is used to pay for various costs for the team. What the team usually does, if they're a legitimate team and hardworking and they get lucky enough, and like if everything lines up, what they end up doing is turning that money that came from investors into a project that's actually valuable, that generates value that customers start being able to recognize. That's when the project starts generating revenues, because customers recognize the value, and so they put in this money, M5, and they get value in return. So the investors' money, through the efforts of the team, has been turned into value that the customers pay for with this M5 flow. Now, things are slightly more complicated because the team often has equity as well. Effectively, they're putting in sweat equity as well, or they're getting sweat equity in exchange for their efforts and being paid less than the market rate for their role usually. But that's basically the essential equation of any kind of project, whether that's an NFT project or a crypto project or anything. The reality, once again, worth reiterating, is that money in equals money out. So in this case, M1 plus M5, which is the money in, has to equal M2 plus M3 plus M4. Since M1 is usually fixed at the beginning, and maybe there's a few ongoing funding rounds, but there's a certain limited amount of money that comes in, and it can't just run on this forever. At some point, customers have to come in and start paying for the product, and that generates the money to pay back the investors, to pay the team, and to pay for all the other costs of the project. So where the picture is different for NFT projects is that they don't actually have customers. So those are out. It's very rare that NFTs have actual customers like a normal startup would. Maybe they sell some merch or something, but that's not usually enough to actually justify any sort of valuation for the project. I mean, Basie sells some jumpers and some hats and stuff. That's not enough for the billion-dollar valuation of the project as it is now. The solution that the PFP space has stumbled onto, which I think is a brilliant solution, is to turn the investors into customers. So instead of the value going to customers, the value goes to the investors here. That can be sustainable, but it all depends on what kind of value we have here. It's worth going back to this picture a little bit and noticing that the equation still holds even if the customers are no longer there. So even with M5 missing, M1 has to equal M2 plus M3 plus M4. The money that investors are putting in is equal to the money that investors are taking out, plus the money that the team is being paid, plus all the other costs of the project. That's a restriction that is not broken even once you switch to this model of value, which is where the subtlety comes in, because often projects will disguise this value in various ways. They'll make it look like something that's not money. And that's where the Ponzi sort of creeps in. Now, it's worth noting that over short time periods, it's possible to kind of evade this equation a little bit. You might actually end up being able to make it look like you're able to pay your investors and the team and the other costs while only receiving money from investors. And it seems to be sustainable at first. But if you think about it in the longer term, it starts to become obvious that it's not actually possible to sustain this, because the money that is being paid back to investors and paying for the team and other costs is coming from the later investors, and the earlier investors are the ones that are being paid off by this money. And that's where we end up with that Ponzi scheme that we started with, this idea that, okay, I'm not going to bother having a project or a product that generates any kind of revenue from customers. Instead, I'm just going to pay off the old investors with the new investors' money, and so long as I can keep the hype going, this thing is sustainable. But of course, you can never keep the hype going forever. So with startups, it's harder for this model to turn into a Ponzi, because investors only invest at point events. They invest when there's a funding round. They're not interested in taking money. I mean, some of them might be, but they're not legally allowed often to take money from later investors as a way to pay off their earlier investments. There are some circumstances under which that's possible, like later investors might buy out earlier investors. But somebody with a pile of money is still sitting there waiting for an actual liquidity event, whether that's the company being acquired or customers putting enough money into the company that it's able to float an IPO. Either way, the investors in a startup are not able to just make money from later investors. But in NFT projects, of course, the fundraising is continuous. It keeps happening. So therefore, it's much harder to tell who's actually paying you for your bags when you're selling them. So the way that a lot of projects have addressed this is they've realized this. They've cottoned on that value is what needs to be here rather than money. And so they provide something that looks like value, but they kind of get it wrong at the same time, because actually often the value that they provide here is not non-Ponzi value. It's still value that's in the form of later investors. Let me give you an example. Let's say I'm running a project. Let's call it the cardboard cutouts project, whatever. It's just a random name. So I've got the cardboard cutouts project. I've managed to raise some money from early investors. They've put money into my project. I've paid off the team some of the costs. I've got my ongoing budget secured for the rest of the year or for the next year even. I've paid for all the other costs of the project. And I'm now thinking, okay, how do I return value to investors? I know. I'll do an airdrop. I'll release a new sub-project. It's not going to be the cardboard cutouts. It's going to be the cardboard kids, like the cardboard cutouts, but smaller. And I'll release that. And that will make some money, and I'll give that back to the investors. Or even I'll just release that directly to the investors and they can sell it to other people. And that's how they get value from the project. Well, if you do that, congratulations, you've managed to thinly disguise your Ponzi scheme, because actually any money that's coming back to the earlier investors at this point is just money from later investors. Future investors buy those cardboard kids. They pay the earlier investors who bought the cardboard cutouts. And that's not sustainable. At some point, the hype runs out and this breaks down. I want to say also that the investors are often complicit in this, because many investors in the NFT space are not actually looking for anything valuable out of the projects that they're buying into. They're actually just looking for Ponzi's. They're just looking to get some money back out. You can also recognize which projects not to invest in if you don't want to invest in these kind of projects by spotting what sort of investors are in and why they're in there. If you take many of the more notorious garbage projects out there, often you can tell quite easily that the only reason why somebody is buying the project is because they hope to sell it for more to a later investor. They don't expect to get any value from it. They don't expect that they will use the project in any sort of way other than selling it on. And that's the case for many utility-free projects, meme projects. And right now, as I record this video, there's the Kevin meme that came out of the Pixelmon disaster. And people who are buying Kevins are not buying it for the sense of value of owning a piece of history. They're buying it for 4 ETH because they think they can sell it for 5 ETH. That is a Ponzi. And there it's quite obvious. My point is that even when the project appears to be giving something other than just money from later investors, it's really worth digging into what they're actually offering and what investors are actually expecting. And that can help you determine whether a project has long-term sustainability or not. Another pattern that people often use is some kind of token. They say, oh yeah, you'll buy this cardboard cutout and you're going to get paper tokens. The paper tokens will have value, and that's how you're going to, that's how this becomes a valued investment. But of course, the paper tokens are valuable only because later investors want to buy them. So again, it's a disguise over later investors' money. Even if some utility is given to the paper tokens, you have to ask yourself, if you really want to critically evaluate those projects, is it really valuable, or is it just a thinly disguised way to pay back earlier investors with later investors' money? And if that's what it is, then it's another Ponzi disguise or not. There's also some other ways that projects kind of disguise this. Another example is collaborations or free mint slots or whitelist slots. They kind of like, if the thing that you're getting as value is a substitute for I'm going to make more money, then usually it's basically a Ponzi. And that's a good way to recognize it. Although it does take a little bit of honesty with yourself. Like, why are you getting into this project? If it feels like really the only reason why you're buying into it is because you want to make more money and you don't see any value whatsoever to actually holding the project, then you're probably engaging and collaborating into creating this Ponzi scheme. And, you know, that takes a little bit of humility to admit to yourself. Certainly it does for me. And also, I don't want to suggest that you have to limit yourself as an investor to projects that where you might be the customer yourself, where the value is directly useful to you. It is enough, in my view, to see that there is a use that is valuable to somebody in the market, but to genuinely convince yourself that this is actually valuable, and how valuable is it. As an example, for me, when I looked into the investment in Crypto Coven, I evaluated it rightly or wrongly as a club type NFT. And I figured it's a club for spiritual people, witchy people. I know a lot of witchy people. I know they exist. I know there's a market. I know there's a lot of Web3 people. Is there some overlap between the two? Probably. I think the club economics works reasonably well. People will want to be part of a club of witchy Web3 people. Therefore, there is some value to this project. Is this value 50 ETH? Is it 1 ETH? I don't know, but I figured that it was probably worth more than the mint price of the project, and so I minted and bought some more around mint. Here's another model that doesn't work, that's relatively frequently used, is where the project literally says, we're going to pay you money from the royalties, and that's how you're going to make money from the project. Lazy Lions did that, Llamaverse has done that. That doesn't mean necessarily that the projects are unreputable, but if that's the only value that you're getting from the project, then you've got to ask yourself questions. Because if you're being paid royalties, then what you have is a relatively small percentage of this M1 money, so like maybe a tiny percentage of this ends up going back here and being used to pay you back. That can never end up repaying the amount of money that you've put in, unless the project, of course, grows exponentially and you've invested at 0.01 ETH, and then now the project is worth so much that you're getting that kind of royalty every day or something. But the only way projects grow that fast is basically via some kind of Ponzinomics and by getting everybody excited about the Ponzinomics. Now, I've written many threads about other projects. I've reviewed projects like Basie and Macy and Robotos, and I've also written threads about different value models that I believe are available out there. And I'm not going to go into those in the scope of this video, but I will be making more videos about this. So if you want to see those videos, please be sure to subscribe and turn on notifications and do all that random stuff that people do on YouTube videos. But the key that I want you to take away is that whenever you approach a project, it's really worth querying what that value element is. what is it actually that you're getting from the project, or what are customers or investors getting from the project, and really digging to try and figure out, is it money from later investors? Because if it is, that doesn't mean you shouldn't buy it. I can't give you advice about whether to buy or not buy those projects. That's really up to you, whether you want to trade or buy those projects. But you should know that if the value that you're getting is 99% or mostly money from later investors, if there's nothing else, it's very unlikely that the project will pivot into something else somewhere over its lifetime. So probably you're buying into some sort of unsustainable project, a Ponzi, or a project with questionable sustainability, whatever you want to call it. But the point is, this long-term future is definitely not assured. And so you might want to think twice about holding it long term. It might make a great trading opportunity. And it's also possible that a project that starts off as a Ponzi like this will later turn into something really valuable and worthwhile. For all I know, that's already happened multiple times. Smart people who start off a project like this stumble into a Ponzi, but then build something big because actually it gets a lot of attention. Might see that all the attention that they generated, all the hype, or the perceived value that they've generated around the project is worth more than the scam money, basically. And they might be convinced, or they might convince themselves to leverage that and actually build something real. If they're smart enough, that's what they'll do rather than run away with the money. But for you as an investor, you definitely want to ask yourself those questions, query that value, be clear enough with yourself about what it is that people might be buying here. If it's difficult to do this by yourself, maybe talk to somebody else. Try to explain to them what value is there in that project. Try to pick somebody who's not fully bought up and card-carrying member of the NFT brigade, because they'll often just sort of ape in and degen into the same projects as you do, and they might have the same blind spots as you do. But try to convince somebody who's not into NFTs that there is something of value here. If I was to explain to somebody the value of being in Llamaverse, for example, disclosure, I own some Llamaverse. It will be in the link below my transparency report. If I were to talk about that to somebody, I would explain to them how Llamaverse offers value in the form of great learning. There's a lot of really skilled traders there. You get to learn from NFT Llama as well. He's quite available. And so I've learned a lot about trading and about trading NFTs from there. I've learned a lot about the NFT space in general, which has helped inform these threads and these videos and my investment strategy. There's also whitelist opportunities in Llamaverse, but there's a really deliberate, concerted effort to go and work with other projects, not whitelist opportunities in a later airdrop of Llamaverse. It's whitelist opportunities in other projects where there is value coming in from other projects. Now, there's still some questions around how that works across the whole space, because it could be the entire NFT space is a giant Ponzi scheme. But that's another discussion for another time. The point is, there is value coming in towards the investor slash customer that isn't just money from later investors into the Llamaverse project. It's money that might be coming from investors into other projects. It's money that might be coming in from investments that I choose to make after being informed and learning from being in the Llamaverse Discord. Or it's just a utility of getting to be with these people in the Llamaverse Discord and learn from them and talk to them, and just even the enjoyment of hanging out with people who share similar interests with me. So, TLDR, whenever approaching a new project, look for the utility, look for the value, and look to make sure that that value is not in the form of finances from later investors in that same project or in a very closely related project. And spend the time to think about this. Detect where is that value coming from? What is actually that value? And if you can't figure out what the value is, probably there isn't any. And then invest or don't invest, mint or don't mint, that's entirely up to you, but do so aware that there may well be no sustainability to that project. Thank you very much for listening. Hopefully you enjoyed this video. Please leave a comment. I'll do my best to respond to all the comments, and feel free to hit me up on Twitter as well. If you enjoy this kind of content, you can find my threads on swombat.io. You'll also find my transparency report on swombat.io/transparency.html. And also, if you want some daily market health analysis, swombat.io/markethealth.html, or follow my Twitter to get these updates daily in your tweet stream. Thank you very much. Have a lovely day, and good luck investing and trading.